Now, the Monetary Policy Committee is expected to meet for its 250th meeting, holding today and tomorrow, to review global and economic developments within the last 2 months in the Nigerian economy. Robert Omotunde, analyst at Afrinvest, joins us now for pre-MPC Talks. Robert, it's great to have you in studio with us. I guess before we talk about the MPC, I just want to get your reaction to those Q1 numbers that came through.
Well, in our view, it's not unexpected. Okay, given what has been happening with within the macroeconomic space, you recall that about a week ago, the CBN released the PMI data, although that was for the month of April, but in March and also in February, we've had that PMI figure coming out below 50% points, which is more or less showing contraction of manufacturing sector. So in our view, what we've seen now is a reflection of the general gloomy picture that we can see within the economy, you know, and it's just so unfortunate at this time that the economy is churning out a negative GDP growth. I mean, if you look at it, this is an economy where the population growth is about 2.6%, about 3% on the average. If labor productivity is even recorded at 0%, we have no business, you know, having GDP contraction. I mean growth. Contraction in GDP growth. So it's more of some factors, some self-imposed, and some that are caused by, you know, the general fall in global oil prices.
And I guess the big question now is, what will the MPC do? And I think Yvonne mentioned there that, you know, they believe that there's more focus on, you know, inflation, you know, than perhaps that slowdown in growth. Do you agree with that? We could see that come through.
Well, if you go by the past communique, I mean the past MPC meetings, indeed, since last year, I think about the last meeting that was held last year, the committee had noted the need to stimulate growth within the domestic space, but it appears most of their decisions have not been focused on achieving a growth stimulation objective. They've sort of, in quotes, left it for the fiscal authority to do. And that's why we've seen the recent moves by the committee. If for any reason interest rate has a pass-through on the amount of credit that is advanced within the economy expected to stimulate growth, then the committee has not done so fantastically well in terms of stimulating domestic growth.
Now, what are the monetary policy implications of that guided deregulation of the downstream sector that we saw come through?
Well, we believe that what we've seen, it's more like a reflection of the reality. And if you look at it, the 41 items that were banned from accessing forex from the CBN constitute about 30% of our forex utilization. Okay, and importation of petroleum products also constitute another 30%. If you analyze it, that even the items that have not been banned by CBN, you know, because of the level of the reserves, the CBN has not been able to meet more than 50%. So it means that technically we have about 80% of our forex demand that's being sourced from either autonomous sources, BDC, or the parallel market. So what, in our view, the committee should be doing now is to more or less recognize a market that has already taken sort of a currency adjustment by the way rates in the parallel markets have been priced. And that's why we believe that in this meeting, the committee needs to take a very proactive step, you know, in addressing that. We have proposed that we think what the committee should do is, first of all, to take a currency adjustment that will be close to the parallel market rate, which was guided by the PPPRA template at 285 naira to the dollar. And not just that, doing that alone without also freeing up the controls, particularly in terms of the 41 items that have been banned, you know, will not achieve as much results. So we've placed a 50% probability on it, given the body language of the committee, and even though we believe that is what is best for the economy at this time.
Okay, now you're mentioning, and you just mentioned there that those 41 items that were excluded from accessing forex, that you think that the central bank should reverse that policy, but that policy was made for a certain reason. So obviously if we reverse this, in a way, there's no point. We might as well have not even made it. Are you saying that this was not a successful move at all?
Well, we are saying that the move in the first instance created the pressure we saw at the parallel market. And what we are advocating, of course, looking at the level of the reserves at $26.6 billion, the concern of the CBN, and the committee is to ensure that we don't suffer further diminution of that level of reserves. And we're saying that if the committee can at least recognize the market exchange rate, which is already set by the market anyways, that it's even in protection of that currency reserves, which the committee is trying its best to protect. So the technical point here is that yes, the CBN may have brought in that control in order to ensure that they save the reserve, but we're saying that this control created the pressure in the first instance. So more like free up the system, liberalize the interbank market, such that the CBN does not necessarily, like they are doing right now, they don't meet all the demands, quoted by companies. So it's the same thing that will happen. The CBN does not necessarily need to meet all demands. In fact, they don't even have the capacity to do that, but more or less creating a system that allows different market players to play, when you have FDI and FPIs having the free will to come in, and the CBN playing the stabilizing role, of intervening when they have to.
All right, let's take a quick break. We will come back to you, of course, to talk a little bit more about your predictions for that MPC meeting. Robert Omotunde, analyst at Afrinvest, will still be here in studio with us. We're still talking about that upcoming MPC meeting that's, of course, holding this week. Now, bond yields have been on the rise as investors expect a hike in the MPR on the back of the rise in inflation. We still have in studio with us Robert Omotunde, analyst at Afrinvest. We'll talk more about that. And this time, we'll talk a little bit more about the impact on the markets. Robert, it's great to have you on the show, just as I mentioned before. So I wanted to ask you before we went to break, though. Okay, so what are your predictions in general for this meeting? What will happen to MPR? Will we see a devaluation, as many people are expecting? And will there be any changes to the CRR at all?
Okay, first on devaluation, our position is clear, even though that is what the committee may not toe that line. If there is any market information that is guiding, the last auction that was conducted on Thursday, the CBN intervened at 197, if that is anything to guide. But we believe there is a need for currency adjustments. On CRR, our position is neutral. We think the CBN should retain the CRR at 22.5%, that it currently is. But MPR, on the last MPC meeting, the committee guided that they're looking at achieving a real interest rate environment, and which was why they took MPR from 11% to 12%. That was when inflation, that's February inflation, was 11.4%. But in the last 2 months, we've seen further rises in inflation figures. Currently, it's at 13.7. In the previous month, it was at 12.8. So it's more like if the committee wants to stay consistent, they would want to take a major move on MPR. We have guided that given the current interest rate environment and our fair projection for May inflation, which we have put at about 12.6%, 14.6%. It means that if the committee wants to achieve a real interest rate environment, they are looking at an MPR hike of about 100 to 200 basis points. So, but we believe that that's not the solution, or that's not what the committee should consider at this time, even though that may still be the direction they will go. And our reason is simply because we've seen the market fix interest rate, especially yields in the fixed income environment, at much more market determined rate. So we believe that if the market wants a real interest rate, yields will be priced appropriately. So the issues that we are having now that's causing this inflationary pressure is feeling from majorly from FX challenges that we have. So that's why we believe that the CBN should go to the cause of the problem
and make a move
and fix it.
Yeah.
Otherwise, it will just be treating symptoms instead of the.
If we do see MPR, move to, say 14–15%, now how will that impact on loans? Will we see sort of a direct implication over perhaps the next 2 months before we have the next MPC meeting? Because that's bad for loans. I mean, people are already taking loans at over 22–25% now.
But our study of lending rates in this market, prime lending and maximum lending rate, does not suggest that it moves directly with changes with MPR. What we would likely see would be movement in yields, short-term and long-term yields, which market has already priced, in expectation that the MPR is going to take a major move on the MPR hike. So we even think that whether or not they take this decision, even if they hike MPR by say 200 basis points, after a week or two, you will see some yields correction, downward pricing, because what the market is more or less doing is waiting, and that's why we've seen the sell-off, that let's take advantage if there will be an increase in MPR. But for loans, we don't think anything will significantly change. What has been driving the banks in advancing credit is their risk profiling, so to speak, not necessarily whether MPR, we saw when MPR before the crisis, 2008, 2009, MPR was lower than 10%, and we still saw loans, prime lending rate and maximum lending rates hitting as high as 25% and in some cases 30%. So we don't think that that will significantly impact on borrowing, but on the side of government is something to worry about.
What about the market? I mean, obviously, when you look at bond yields and treasury bill yields, I believe treasury bill yields are around 9.7% and bonds slightly over 13%. And I heard you mention that this MPC move, or what could happen at the MPC, has already been priced in the fixed income market. But obviously, if we have a situation where MPR is then set at 15% and then we're having bonds at 13.7%, it just automatically makes the fixed income space not very attractive.
Yeah, but we've seen that before. Even though we think if there is a 200 basis point hike in MPR, you might see initial market movements, before you start to see the correction. But it has happened before, even in 2015, when MPR was 13%, yields at some point, average at about 12%. So it's not exactly a misnomer when you see yields being priced at a level lower than the MPR. It's all determined by market dynamics. Several other factors determine where the market movements will go, not necessarily where the policy rate is fixed.
What about the equities market? Because obviously now that those Q1 numbers have come through, some people are saying that we're likely to have a week of, well, especially today, perhaps we're going to have losses all across the sectors because of those Q1 numbers. I don't know if there's really a direct correlation to what could happen in the stock market, obviously in regards to everything that's going on, and also in anticipation of the MPC decision as well.
Well, the Q1 GDP numbers would have already been reflected in the Q1 numbers which the companies churned out. That's their first quarter results. Remember that this is first quarter GDP figure that we're recording at this time. But the main thing is that what the equities market is probably pricing is, I mean, theoretically, inflation should be good for equities market, because if prices are higher, companies' revenue and earnings in turn will improve. But what we've seen driving this market, the equities market, so to speak, in the last few weeks, has been the MSCI news, and the recent move by the NNPC to sort of liberalize the oil market, I mean the downstream sector in Nigeria. So, and again, the market is also pricing a possible move by the MPC to adjust the currency. If they do, then we'll see a lot of FPI coming, and be attracted to the equities market. So, and that's what the market has been pricing.
It will certainly be good to see how the markets respond today, and also we are obviously waiting patiently in anticipation of that MPC decision. I think this could be a rather important one, given everything that's happening in the macro space right now. Thank you so much for joining us on the show, Robert. Robert Omotunde is an analyst at Afrinvest.